any investment, you can have periods of several years where that investment goes down 50%, or even, next Fibonacci number is 61%, and still be in a bull market.
Right. We've seen corrections similar to this, at least in terms of a percentage off of their peak, already 4 times since 2001, where you've given up 19 to 23% off of a peak number. And what's fascinating is people are less concerned at those low numbers. 20% of 300 is $60. Nobody really cares one way or the other about a $60 move, although the percentages remain the same. By the time you get to $1,000 gold, that same 20% correction is a $200 move, and all of a sudden it starts to tap a particular nerve. It is the same percentage terms. As you mentioned, you go through these Fibonacci numbers, whether it's a third or a half or a 61/8 correction, and this is pretty normal behavior. The most important thing is making sure that in the larger context, your assumptions are correct. And in this case, what you determined in 1981 was a context of deflation and declining interest rates over the next 20 years, a period from 1981 to 2001 where it just didn't make sense from a capital gain perspective to be in gold.
Right.
And that same sort of large picture context and inflationary period, I'm really curious where you come up with a 30-year inflationary cycle, because 30 years that's a long period of time.
Yes, it's actually going back in history, 200 years in the U.S. You can go back using British data for another 200 years. That's what my work made me conclude, that these cycles last about that period of time. Now, they're averages. It doesn't have to be 20 years on a button. And I was very surprised that my 20-year downturn for gold in 1981 turned out to be exactly right. Usually the cycles are not that dependable. They can be off by a couple of years in either direction. But this time it really worked out. It was just absolutely amazing. So, if the scenario keeps on panning out, then, it's kind of a confirmation that you may be on the right path. Once the markets start deviating from the scenario, then you have to go back to the drawing board. But right now, everything is in gear. And in fact, that 30-year up period, I wondered about that. I said, what could produce a 30-year period of rising inflation? And, in 2001, 2002, when deflation was the major problem, it just didn't seem probable. But it's turning out. Now I think we have the answer. And the answer is that the 800 trillion, and that's with a T, the mountain of derivatives out there that is imploding, is necessitating the central banks to fabricate so much cyber money. It used to be printing presses, now it's basically computer money. And just to keep the system from collapsing. And that, I think, is the key right now. And that is the answer, how you can have a long period of rising inflation.
It seems to me that 30 years would necessitate something so structural in change, whether it is a combination of Fannie and Freddie Mac, basically being subsidized or bought out by the U.S. government, adding $5 trillion or a number close to that to their balance sheet liabilities.
That is a given now. I think that has to happen. That is the only solution to Fannie and Freddie. There's no other solution. They're unable to really raise any long-term capital in the markets. Today, Freddie sold some of these reference securities, which is really not what they need. They need some long-term capital, but nobody's willing to give it. They've been trying for the last 6 months to raise long-term capital. There's nobody out there that wants to buy any long-term debt from these GSEs. So the government is going to end up owning Freddie Mac and, just as you said, Fannie Mae. Another $5 trillion of debt on the U.S. government's balance sheet. And that's how it's going to go. And, let's not forget that we are not yet in the recognition stage of this economic downturn. And I think one reason is, that we have not seen the soaring unemployment, although unemployment has risen substantially, but we haven't seen the real surge yet because U.S. manufacturers have been very smart over the last 6 years in outsourcing. So the manufacturing is outsourced. There are hundreds of thousands of people working offshore in these emerging countries where they build these factories and so on, and they're not on the payrolls of U.S. companies anymore. They used to be on the payrolls. So now the burden of laying off all of these people and of having all these empty factories and all the machinery standing there not being needed to produce anything because there are no buyers. That burden has been shoved off to emerging markets. And therefore, I think that the best investment for the next several years is to just sell short the emerging markets. You can do it very nicely now using the ETFs.
So what you're saying is, at this point, unlike past recessions or depressions in the United States where we had unemployment within our own boundary, at this point you're saying this translates to a worldwide recession.
Oh, this is a global problem, which makes it that much more dangerous because in past recessions, you could always find some area in the world that was counter-cyclical. If the U.S. was going into recession, somebody else might be starting a boom. This time it's global.
Well, it seems to me that also raises the stakes in terms of political volatility, because if we've outsourced an employment or an unemployment issue, and that now is a headache for some other government to deal with, it's also their political headache. To have that many more people unemployed is that many more people who can strike, that many more people who can protest, that many more people who can basically cause revolution. That's the beauty of employment from a controlled economy or from a political standpoint is, and this is one of the reasons why we've always encouraged as a nation people to own homes. If you own a home, if you have a mortgage, you need to work to pay for it, and that enters into, it creates a tremendous amount of stability if people are forced into a position where they have to always work.
That is an excellent point. Civil unrest is going to be the biggest problem for the emerging countries over the next 10 years, and China is going to have huge headache, and this has been the fear of the Chinese government. Let's remember, in many other countries, they can elect a new government. In China, the only way they can get a new government is by toppling the current one. And I remember talking to someone in Hong Kong who was very high up in the Chinese government. He said the biggest fear that the people in